Y'all don't listen to all the stupid stuff you hear on social media. Um, I just had, I heard literally the dumbest thing I've ever heard in my life as it pertains to paying down your mortgage. This person said to make 4 payments a month, which is going to reduce your mortgage, but the suggestion was to divide the mortgage payment into four. So you're still only making one payment for the month. You are not changing anything. I want us to think before we speak and think before we put into action the things that people say online. We got to use our common sense. Okay. Now, how could I tell you that what that other person said was dumb and stupid without giving you a real strategy on how to save an interest as well as reduce the time frame that you will pay your 30-year mortgage? So as you know, your mortgage is about 30 years unless you have a 15-year mortgage, or who has a 60-year mortgage? I hope not. Anyway, the way you reduce the number of years on your mortgage is to make an additional payment to the principal annually. Okay? That'll shave somewhere between 5 to 7 years off. So what you can do is divide your mortgage payment into 12 and put those small increments a month toward the principal. Somebody might want an example. So let's say your mortgage is $1,500 a month. You want to divide 1,500 by 12, and that's going to give you 125. So that means every month you can either pay an additional $125 to the principal, apply it to principal, or you can take $125 a month and put it into a savings account, a high yield savings account, maybe like a money market account, so that you can grow some interest on it. And if you do that, I would actually suggest that that be the best option, because that money can actually grow. And so that 125 every month is going to grow at whatever annual annual interest rate. And so by the end of the year, you take whatever you accumulate in that account and you apply it to principal. Now, I'm making the assumption that you understand what I mean when I say principal. Let me not do that. So when you think about a mortgage payment, it has four parts. I talk about this pretty often. So you have principal, interest, taxes, and insurance. Unless you are with some type of financial institution where you only pay principal and interest. So what I'm referring to right now, the money that you get from the financial institution to buy your house, is the principal amount. The interest is the amount or the percentage that they charge you to borrow the principal. Now, when I induct you into the Home Hero Hall of Fame and we're sitting at the closing table, the title attorney is going to slide you a piece of paper. That piece of paper is called an amortization chart. That amortization chart is going to list every single payment you are going to make every month for the next 30 years. When you review the amortization chart, you're going to notice that most of your payments between years 1, maybe 10 or 15, are going to go towards the interest. So if your mortgage payment is $1,500, a lot of that $1,500, some of it is going toward taxes and insurance. A lot will go to interest, and very little will go toward the principal. So that means you are paying the cost of borrowing first. Okay. Then after 10 or 15 years, you will start to knock down the principal. Now, you know you're borrowing tens of thousands, mostly hundreds of thousands of dollars, and you don't start hitting that until after year 10. So now that we understand what principal is, we know, of course, we know what interest is. The other thing that I have to tell you is that
you're going to probably pay double for your house than what you bought it for. Yeah, that's the bad news. But I also have a strategy on how you can recuperate those losses from interest. We're so accustomed to being on the wrong side of interest that we forget that we have an opportunity to be on the right side of interest. And so, let's say you're being charged 6 to 7% on your mortgage. So you're losing 6 to 7% to that financial institution. All right. So the way you're going to recover what you will ultimately and inevitably lose toward paying interest is you're going to find in your budget another 125. Again, these are just example numbers. So if I told you to put 125 additional so that you can pay one extra payment a year toward the principal, then you're going to find another 125 and you're going to now invest that 125 in you're going to invest it maybe in like the S&P 500 in a mutual fund. And so that's going to yield you 9% or greater. So you're going to get back the amount of money that you lost toward interest to the bank that you borrow money from for your home. You're going to get that money back. All right. So that's the play. That's it. Ask me questions if you need to.